All of the problems covered in my videos can be downloaded at accountingworkbook.com. If you go to the website, click the PDF link, you can download a copy of the workbook for yourself. Also on the website, you'll find links to all of my accounting videos, not just the ones I've uploaded to YouTube. I've uploaded over 100 extra videos on this website that you can't find on YouTube. So I do hope you'll check out accountingworkbook.com. All right, let's begin our problem. All right, let's examine problem 9.3a, bond issued at a discount. So it says on February 1st, 2017, Tinger Inc. issues $250,000 10-year 5% bond. The market rate of interest is 6%. Okay, so when I see I issue a 5% bond, I'm Tinger Inc., and the market rate of interest is 6%, I know I won't get the full $250,000. I know this bond will be issued at a discount. Why do I know that? Well, if I'm offering 5%, but you can get 6% for similar other companies in the market, then nobody's going to pay $250,000 for my bond. I'll have to offer it at a discount. It says because the market rate is higher than the bond rate, the bonds issue at a discount. Okay. The bond quote is 92.561. This number, this 92.561, that's the percentage of face value that I get for the bond. So I got 92.561% of what I asked for. I got 92.561% of $250,000. How much is that? Not 3. 0.92561 times $250,000. I got paid 23140. We're going to round up to 3. 231,403. That's how much money I got paid for my bond. The bonds pay interest semi-annually on February 1st and September 30th. Or on August 1st, pardon me. The company's fiscal year end is September 30th. Okay, so we're going to have to do this thing called an amortization schedule, but before I do that, I actually want to do the journal entry for the issuance of the bond. I know when I issued the bond, I got paid 231,403. So let's do that quickly. Debit cash 231,403. I forgot the date, but I'll come back to the date in a moment. Debit cash 231,403. I know, I'm going to leave a bit of space here, that when I pay back the bond several years from now, I got to pay back the full amount, $250,000. What's the difference here? The difference is the discount on my bond, and the discount, this bond was discounted for like $18,597, right? It was that was the discount. So the journal entry is dated February 1st, and we've answered the first journal entry there, but we haven't actually done the table. So taking a bit of a step back, we offer this bond to the market. We say, okay, $250,000 is what we'll pay back, and we'll pay you back with this much interest. The market says, you know what, it's not enough interest. We're not going to be willing to pay full price. They pay $231,000 with a discount of $18,000. If you think about it, this $231,000 that I borrow and I'm going to pay back $250,000, the difference here, this $18,000 is like interest, right? I'm paying back $18,000 more than what I borrowed. It's kind of like interest. And what this table that we're about to prepare is all about recognizing our discount as interest expense. We don't do it at the end. We don't wait till the very end, however many years from now when we pay it back. We recognize it as interest slowly over time. Your instructor might be teaching you there's a straight line way of doing this. That way is not recommended by any accounting standards. The way I'm teaching here is called the effective interest method, and this is the sort of standard way of dealing with bringing this discount into an interest expense. So now I'll have uploaded this, and I'll provide you with a link to this table. It looks a little bit different. I copied it into my software, and it looks a little funny in my software, but it should be very similar. And in fact, you should be able to do it in Excel. I might do it in Excel in a future video, but I wanted to do one by hand just to kind of show you that it can be done by hand. So our first semi-annual interest period, the first date relevant to our bond, is February 1st, 2017. What happens on this date? Is there an interest period? No. There's no interest payment. Is there an interest expense? No. There's no discount to be amortized, but there is a discount account balance. We said when I issue this thing, there's a discount of $18,597. And we also said that this thing we were going to get cash of $231,403. And that's the bond's carrying amount. Now I should actually fill out the top part of this while I'm here. Our interest payment was going to be based on a 5% bond. That's our promised amount of interest. So our interest payment is not 5% of maturity value, it's half of that because everything on a bond is semi-annual. So it's 2.5% of my maturity value. My interest expense, not 6%, it's half of that. It's 3% because again, everything related to a bond here is semi-annual. Is it a discount or a premium? This is a discount, so I ignore any reference to premium amortization. It's not a premium account balance in this last column. Ignore the bottom, blank plus D. Now the blank here, blank minus D or blank plus D, this is the face value of our bond. The face value of our bond is $250,000. So let's start to fill this in, and you'll see once you've got this top part, and I mean, maybe I should just repeat what I've just said. I guess you can replay it, but whatever. This is how I do it in class. I say, okay, is everybody clear on this? So filling this out, our interest payment is based on what we promised to pay, right? And we said we promised to pay 5%, but bonds are all semi-annual. They pay interest semi-annual. That means twice a year. This is a 5% per year, so we just go, okay, well, it's 5%, but since it's semi-annual, each payment will be at 2.5%. And that's what we fill in here, 2.5%. Our interest expense, well, if we halved our interest payment, we're going to have our interest expense. It was 6%, but it's 3%. We know it's a discount. How do we know it's a discount? Well, the question says it's a discount. We know our bond quote was below 100. We know our market rate was higher than our bond rate. So we know it's a discount. So I just scratch out any reference to premium just to make sure I'm working at a discount. And the bond carrying amount is the face value of the bond minus the discount. So 250 minus 18,000, that's how we got 231. Okay, let's do the next bond payment. And I think we'll have a better picture here. So it's August 1st, 2017. We make a payment. What's the payment? It says 2.5% of the maturity value. The maturity value in our bonds case is $250,000. So 2.5% of $250,000. Let's do the math. 250 times 0.025, 6,250. That is 2.5% of our maturity value. 6,250. Interest expense, 3% of the preceding bond carrying amount. Okay, so 3% of what? Well, you can see column E is called bond carrying amount. You can see it right there. So 3% of the preceding bond carrying amount. So if I'm in this cell, the preceding means the period before, and I go over to here, and I go, oh, it's got to be 3% of that number, whatever it is the period before. So again, I take 231,403, and I want to multiply that by 3% times 0.03, and I get 6942. I'm going to be rounding to the dollar here. 6942. Discount amortization, B minus A. Okay, so 6942 minus 6250. And I get $692. Discount account balance, D minus C. So column D, which is right here, kind of hovering the eraser icon, column C. So I take 18 grand minus 692. And I get 17,906. I was trying to make it, let me try that again. 18,590. Is that a 2 or a 7? Sheesh, I can't read my own writing. 18,590. Oops, why can't I go down any further? This is strange. 18,597. So 18,597 minus 692. Sorry about my writing here, folks. And I get 17,905. My bond carrying amount, I take the bond carrying amount, I take 250,000. This is when I screw up sometimes. I take 250,000 minus 17,905. And I get 232,095. Okay, that's it for August. The next relevant date is going to be February 1st, 2018, and we'll do August 1st, 2018, just to get practice in. So my payment, and once you've done this 3 or 4 times, it becomes rote. My payment is going to be the same. 2.5% of my maturity value, 2.5 of 250 is 6250. And in fact, I could fill this in the next row as well because it's just the same amount. That's why old people love this investment. It's the same payment every 6 months. They get the exact same thing. So it's very predictable. Our interest expense, 3% of the preceding bond carrying amount. Okay, so I'm going to take the preceding bond carrying amount, which is 232,095. I got fat fingers. You wouldn't think so. I think these are just like pianist's fingers, but I tend to really, I did it again. 232,095 times 3%. 6962, well, 6963, we're going to round up. Okay, so 6963 minus 6250, B minus A is 713 for this column. The account balance, 17,905 minus 713, 17,192. Then 250,000 minus D, 250,000 minus 17192 is 232,808. This is pretty mechanical. I'll explain more as we go, but I just want to make sure you've got the mechanism down here. This is called an effective interest rate table. An effective, we're determining our interest expense for the period. That's really the purpose of this. August 1st, 2018, our interest expense, 3% of the preceding bond carrying amount. So I take that number that's in my calculator and I multiply by 0.03 and I get 6984. Clear the memory. I take B minus A, 6984 minus 6250. I get 734. Discount account balance. 17192 minus 734 is 16,458. And lastly, 250,000 minus 16,458 is 233,542. Let me write that a little more clearly. 233,542. Okay. So we've prepared a pretty good effective interest table. And keep in mind the purpose of this is just to determine the interest expense. As I mentioned, you might think the interest expense is what we pay, right? We're paying interest to our bondholders, $62.50. But there's this extra money we got to pay back at the end. We got to pay back 18 grand more than we borrowed to get them back their $250. So it's not only the interest payments, I also have to worry about this $18,000 of interest. So there's an extra, you can see, in this case, $692 in interest above the $62.50. It's an extra $692. What is that? Well, that's the piece of this interest that I want to recognize on August 1st. That's what this table is all about. It's saying, okay, when do I recognize this $18,000 of interest? I don't want to do it all at once. It should be over the life of the bond. And this is how we determine it. We prepare an effective interest table. And you would see if I did this for the full life of the bond, which is 10 years, which would be 20 periods, you would see by the end, this number, the bond carrying amount, getting always closer and closer to the face value of the bond. the discount or premium account balance is always getting smaller and smaller and smaller. If you ever calculate and you get a negative number somewhere, it means you screwed up. You did something wrong. So you don't want to see any negative numbers anywhere on this thing. Okay. Let's do our entries now. Now we're well positioned to do entries. We did the first one, the issuance of the bond. The second one, August 1st, the first interest payment. We do make an interest payment, so let's credit cash. You can see in column A, and I'm looking at August 1st here. Credit cash for $62.50. It says, let's see, the interest expense is $69.42, so debit interest expense. $69.42, and it says the discount amortization is $6.92. Well, I know I'm missing a credit of $6.92, but let's think about what we're trying to do here. We're trying to make this discount smaller, so it was sitting at a debit. I want it to be zero by the time I'm done the bond, because when I pay back this bond, I'm not going to be paying it back with a discount. I'm just going to be paying back $250 grand. There's going to be no discount, so I'm trying to get rid of the discount, so I credit the discount to get rid of it. Okay, that's August 1st. The trickiest couple of entries are coming, September 30th and then February 1st. So September 30th is our fiscal year end. So you'll notice it's nowhere on this table. So we've already dealt with February 1st and August 1st. I'm going to just I'm going to highlight what we're looking at now. We're looking at this February 1st row. Right, that's the row we're concerned with now. And you might say, well, why are we looking at that one? Let's think about the months that line covers off. So that line covers August, and this is 2017, September, October, November, December, and January. That covers a 1, 2, 3, 4, 5, 6 month period. And we want to do the journal entry on September 30th, so we're interested in August and September. We're interested in 2/6 of that information that's held on the line. So when I do my journal entry to record an interest expense, I would say, oh, it would be $69.63 if that was for 6 months. I want to know 2/6 of that number. So I'm going to take 2 divided by 6 times $69.63 to get my interest expense. So let me do that in my calculator right now. 2 divided by 6 times $69.63, and I get an interest expense of $23.21. Well, that's the number I'm going to use. So I'm going to debit interest expense for $23.21. I'm also going to credit my discount, just as I've done up above. Same entry, basically. Credit my discount. And, well, we'll see a difference in a moment. And for how much? Well, the discount amortization, 713. So I take 713. And again, I say, okay, but I'm only interested in 2 out of the 6 months. So I multiply by 2/6 and I get 238. What does the difference go to? Well, you might think debit, interest expense, credit, discount, credit, cash, except for we don't make any payment on September 30th. We make payments every 6 months. So we don't make our payment till February 1st. What is this? This is all related to interest. This is interest I haven't paid yet. This is interest payable. And again, I would have credited my cash by $62.50, but in this case, I only want to record that 2/6 of this is owing. So I take $62.50 and I multiply by 2/6, and I say, oh, it's $20.83. That is my interest payable. And you can see the math works here. If I add these up, it does indeed. $20.83 plus $238 equals $23.21. I have accrued my interest expense properly for the period. Now we got one more entry to do. February 1st, 2018. And what we want to do on February 1st, 2018 is looking at the same highlighted line. We've done 2 months. Now we want to do, we've done August and September. We want to do October, November, December, January. We want to do 4 months here. We want to do these 4. So I take all of this data again and I go, oh, same stuff, just 4/6. So debit interest expense. With the last one, I did 2/6 of 69.63. This time I'm going to do 4/6. 4 divided by 6 times 63, and I get 46.42. I got to get rid of my discount, credit discount. And again, I was going to get rid of it if I had the full 6 months at 713, but I'm worried about 4 out of the 6 months. So I take 713 times 4 divided by 6. It's 475. Now I would think, okay, well, how much to credit cash for? And you might think, well, credit cash 6250 times 4/6. No. We got to pay 6250. So there's 6250 in cash leaving our hands. So we're going to credit cash for the full amount, 6250. You might say, well, what's the difference here? And we're missing a debit here. And the debit is for, if you do the math, it's for 2083. You might say, well, what's that debit? Interest payable, right? It's no longer payable. We've paid it. So we debit interest payable. I squeezed it in there. And there we have our February 1st entry. So a pretty challenging question, and certainly one I'd encourage you to practice. I've got lots of other problems with discounts and premiums for you to practice as well. Let's continue, and I'll see you in the next video.